expressed during today's webinar are those of the speakers, not of Stratford, the speaker's firms, or clients, and are not intended to provide legal or tax advice. I will now turn the webinar over to our speakers.
Thank you. My name is Anthony Diazdi, and I am a partner at Diazdi Ching & Liu, and I practice mostly in the area of international tax compliance, international tax planning, and controversies involving international matters. So today we're going to be talking about the Form 3520. I'm going to be talking about general overall principles of what goes on, or overall principles of the schedules of the Form 3520. And then I'm going to be then talking a little bit about potential ways to deal with a penalty if you wind up having a situation where a client did not timely file a Form 3520 and is subject to a large penalty. And the one thing I want to say is that this area involves an awful lot of law and sites. I don't have the ability to put that all into the slides, so I have drafted a couple articles on this topic, on the topics we're going to be talking about today. And if you're interested in those articles, just please send me an email, and I'll be more than happy to send them to you. All right. So, what is the Form 3520 and what's it used for? Well, it's predominantly used for reporting transactions or distributions with foreign trusts. So the first question we need to ask ourselves is, well, what's a trust, right? So you need to understand what a trust is before you can actually start diving into the 3520. So the definition of a foreign trust is basically, or should I say, a trust is when you have a fiduciary arrangement that allows a third party or a trustee to hold assets on behalf of a beneficiary or beneficiaries. All right. So now, since we've defined what a trust is, what's a foreign trust? Well, the definition of a foreign trust itself, the Internal Revenue Code is kind of circular, but the Internal Revenue Code provides us with a definition of what a domestic trust is, and there's a two-part test. And basically, if you wind up satisfying one of these two-part tests, or you don't wind up satisfying these tests, then by default, you're dealing with a foreign trust. All right. So what are the two tests? Okay. The first test is the court test. All right. The court test basically provides that in order for it to satisfy the court test, a U.S. court must be able to exercise supervision and administration over the trust. Okay. This means specifically that a U.S. court must have the authority to render orders or judgments concerning the administration of the trust, or a U.S. court has the authority to determine substantially all the issues regarding the administration of the trust, and if the trust does not contain an automatic migration clause. So migration clauses, if you dealt with at all with any kind of asset protection, one of the big things in the past was people put things into trusts and it had like a migration clause. So if you had a creditor going after somebody, you had a migration clause that could basically take the trust and move it supposedly outside the jurisdiction of the U.S. So these are things to consider whether or not you're going to satisfy the court test. Now, the second test is the control test. All right. So the control test is satisfied if only U.S. persons can exercise substantial decisions over the trust. And those U.S. persons are basically U.S. citizens, U.S. residents, or U.S. entities, right? So what's a substantial decision? A substantial decision basically involves the timing, the amount of distributions, selecting the selection of beneficiaries, allocation of receipts between income and principal, whether to terminate a trust or not, or whether to sue and defend the trust, or whether to remove or add a trustee, and other investment decisions. All right. Now, let's take a step back here a minute and kind of think about this when we're looking at a foreign trust, because it's important to understand that conceptually we tend to think of a trust as a certain way. We tend to think of it as someone setting up a foreign trust with a trustee to hold assets for a U.S. person in some aspect. But a foreign trust can also encompass other assets. For example, you could have a foreign retirement account. A foreign retirement account can and often will be classified as a foreign trust for U.S. purposes. Certain investment accounts for entities that are classified as foundations, sometimes life insurance can be classified as a foreign trust. And when you're preparing a return, this might sneak up on you with cat-like paws. You're not understanding what you're dealing with. You're thinking you're looking at a foreign bank account, and in reality, it's also a foreign trust. And it's important if you're dealing with any kind of foreign work like this, where something could wind up being a foreign trust, is to look at it early, because a lot of times you have a reporting requirement for a 3520. You also have a reporting requirement for a 3520A. They have two different deadlines, and as we'll find out a little bit later on, the penalties are massive, and the IRS is not very kind about removing the penalties. So, look at what you're dealing with, analyze that account, make sure you understand what it is, and whether or not it becomes under definition of a foreign trust. All right, let's talk about the Form 3520. So the Form 3520 has 4 parts. All right. So what's the first part? All right. The first part is basically you have to go ahead and report any kind of transfers, direct or indirect, from U.S. persons to the foreign trust. And if it is anything was received in exchange for that transfer to the foreign trust, that has to be reported on Part 1 of the Form 3520. So think of it this way. If a U.S. person, and what is a U.S. person? U.S. person means U.S. citizen, U.S. resident, corporation, partnership, limited liability companies that are created in the U.S. directly or indirectly transfers property to a foreign trust. That transfer has to be reported on Part 1 of Form 3520. All right. If a U.S. person also transfers property to a related foreign trust in exchange for an obligation, then the transfer must be reported on a Form 3520 Part 1. A person is related to a foreign trust, or the definition, should I say, of a related person for purposes of this can be defined as a brother, a sister who is whole or half-blood, a spouse, a lineal descendant. So if you're dealing with a trust that has a related party, and then there's a transfer made to it, you're going to have to report that on Part 1 of the Form 3520. A related party can also include a corporation, all right? So if a corporation is directly or indirectly owned by 50% or more of the outstanding stock by a related person, then you can also have an obligation to make that disclosure of that transfer on Part 1 of the Form 3520. All right. If a U.S. person holds a qualified obligation of a foreign trust, that transaction must be disclosed on Part 1. So what's a qualified obligation? A qualified obligation is defined in Notice 9734, and what a qualified obligation is, it's an obligation that's reduced in writing. The term of the obligation does not exceed 5 years. All payments on the obligations are denoted in U.S. dollars, and the yield to the maturity is between 100 to 130% of the applicable adjusted federal rate. All right. And then finally, if you have an executor of an estate of a U.S. decedent, and there's a transfer to a foreign trust by reason of death, particularly if it's a grantor trust, or if it's not a grantor trust, if it's a foreign trust, then you're probably going to have a reporting requirement on Part 1 of 3520. Okay. So let's now talk about Part 2. Part 2 of 3520. When do we use Part 2 of 3520? Well, Part 2 is basically there to disclose ownership, interest, in any portion of a foreign trust. Anybody who's dealt with these forms in the past understands that this is not an easy area to navigate. It's always difficult to understand when somebody winds up owning an interest in a foreign trust. The grantor trust rules kind of kick in a little bit to kind of help us determine if someone has an ownership interest in a foreign trust. And there's common powers that trigger the grantor trust status for determining ownership in a foreign trust. Could be the power to control a beneficial ownership from the trust, a power to add or change beneficiaries, the power to borrow without adequate interest or security, and the power to substitute the assets of equal value of a trust, a foreign trust. These are all indications of ownership of a foreign trust. Equally important, when you're dealing with part two is significant because part two kind of determines how the foreign trust is going to be taxed for U.S. purposes. So let's just say you're dealing with an ownership interest because the trust itself is determined to be a grantor trust. What the trust is determined to be a grantor trust, when I say the trust, the foreign trust, what winds up happening is that the foreign trust itself is basically taxed to the U.S. person who owns the foreign trust. If you have a U.S. person that owns the foreign trust, because of the grantor trust rules, that the assets or distributions or whatever income that comes from that trust is taxed directly to the individual. Now, if you're dealing with a situation that's less common, where you have a foreign person that has an interest in a grantor foreign trust, in that case, the tax itself is only taxed on the U.S. portion of the trust. So let's just say the trust holds, securities, or the trust holds real property. You're only going to be taxed on the U.S. effectively connected income, or you can be taxed on the FDAP rules, which is basically going to be withholding, the 30% withholding on passive income from the trust itself. Now, if you're dealing with a non-grantor trust and you're dealing with the ownership for the non-grantor trust, it's a little bit different here, because what happens is that the ownership itself will be determined by the percentage of the allocation or the distribution or the amount that gets distributed to the U.S. beneficiary. That can be a little bit difficult sometimes to determine, but you kind of have to look through the finances and the assets of the non-grantor trust. When I say non-grantor trust, I mean that this trust itself was established by a person other than a beneficiary. All right, so that's how to determine the interest for U.S. purposes. Now, for U.S. tax purposes, whatever that individual's ownership or their particular distribution from the non-grantor trust that is the amount that they're going to be taxed upon. If you're dealing with a foreign individual who has a beneficial interest in a non-grantor trust, then that individual is only taxed on U.S. source income. You're not going to be taxed on a worldwide income, which is contrary if you have a U.S. beneficiary. All right. Let's now move on to part 3 of the Form 3520. So part 3 is basically discusses trust beneficiaries and basically who the trust beneficiary. Part 3 discusses distributions. So basically, any kind of distributions from a foreign trust itself is disclosed on part 3 of the Form 3520. So first, you have to kind of determine who the beneficiary is. Okay, a U.S. beneficiary is any person that directly or indirectly can receive a distribution from the trust, and whether or not, and that includes an individual that could receive a distribution with a potential amendment of that foreign trust. All right. So, what is the consequences of receiving a distribution? So let's just say you have a distribution from a foreign trust that goes on to part 3 of Form 3520. What are the issues that we might wind up coming up with? Well, one of the biggest issues is loans. All right. So if you have a loan that is being made from a foreign trust to a U.S. person, that's being taxable for purposes of U.S. tax. The exception to the rule is a qualified obligation. We just spoke about a qualified obligation earlier. If it's a qualified obligation and the terms of the qualified obligation are being followed, then it's not a taxable loan. However, if you're just dealing with a straight out loan to a U.S. person, then you're dealing with a tax consequence to that U.S. person. Now, another area which pops up sometimes is that if a trust is held by a foreign corporation. So if a foreign trust holds assets through a foreign corporation, then you might wind up having a guilty or a subpart F tax matter. Now, the general taxation of a trust, let's just say you're not dealing with a loan, you're not dealing with a foreign corporation that's holding a foreign trust. The general tax matters for U.S. people that are receiving a distribution from a foreign trust can be complicated. So let's start off first with basically how it works. And this is basically, it works similar to as a U.S. trust would be in the fact that trusts are taxed on current distribution net income, right? So D&I basically is equal to the taxable income for the trust for that year, and it takes in consideration any personal exceptions, if applicable, tax-exempt income, and the amount of trust deductions and distributions to beneficiaries, right? You come up with that amount, then you have a distribution. If it's done annually, you're probably not going to have much of an issue with what I'm going to be talking about in a minute. If you have a foreign trust and the foreign trust is not making annual distributions of D&I, then what wind up happening is that the D&I is reclassified to UNI or undistributed net income. And the importance of having UNI, which unfortunately I'm not going to be able to get into, but we have some discussions there on slides. It basically is subject to tax on the throwback rules, and basically you wind up having a situation where you're being taxed at the full maximum rate. You don't have beneficial treatment for capital gains, and on top of it too, you have interest being assessed on it as well. All right. Let's now move on to Part 4. Part 4 of the Form 3520 is a little different. It does not apply to foreign trusts. What Part 4 applies to if you have a situation where you have a distribution from a foreign person, or should I say gift from a foreign person, and the gift from the foreign person aggregate amount is more than $100,000. If you wind up having this, then you have a person that is winding up receiving more than $100,000 a year in aggregate in foreign gifts. That has to go on to Part 4 of the 3520. There's special rules as well in regards to any kind of gifts from partnerships or foreign corporations. I believe the amount is anything over $17,335, if my memory serves me correctly. Anything above that has to be reported on the Form 3520. And there are special rules in a code that can go ahead and reclassify gifts from foreign corporations and partnerships and reclassify it as taxable income. All right, let's move on now to the penalties. All right, anybody who's been practicing in this area understands that there is massive penalties that the IRS can assess against you or assess against your client if a Form 3520 is not timely filed. There are two code sections that we need to worry about. There's code section 6039F, which basically winds up providing that if a foreign gift is not reported on a 3520, you could have a penalty that could be as high as 25% of the foreign gift. And then you have a code section 6677, which is a separate penalty involving not reporting a foreign trust onto a Form 3520. You can have a penalty there of greater of $10,000 or 35% of the value of the trust or of the distributions from the trust. So these are serious penalties, right? And these penalties are a little bit different than what we're typically used to dealing with. We're typically used to dealing with, a client getting a notice of deficiency, taking it to tax court, and then resolving it in tax court, whether it's an appeals or not. But here we're dealing with what's called an assessable penalty. The IRS classifies these as assessable penalties in that they assess the liabilities or these penalties, and then they kind of go right after the person assess the penalties and then demand payment. And if the payments are not made, the IRS can proceed with, or IRS believes that they can proceed with, enforced collection actions. All right. So real quick, what are our defenses? Well, the most common defense that people use when they're trying to challenge a 3520 type penalty is reasonable cause. As tax practitioners, and I can tell you when I first got started, you used to kind of sending letters to the Internal Revenue Service, first time penalty abatement, putting together some kind of argument based on reasonable cause, and the IRS would abate the penalty. Not so when we're dealing with 3520 penalties. And so the question is, well, why? What makes it different? Why is the IRS different in its thinking with the 3520 penalties? And about a year ago, there's an article that was in Tax Notes International, and it was a fascinating article, and it discussed a Freedom of Information Act that was served upon the Internal Revenue Service appeals, and asked the appeals division to kind of provide information regarding its training to appeals officers in regards to the 3520 penalty. And what they found was that appeals officers are being instructed to only mitigate penalties on extraordinary circumstances. And to make matters even worse, appeals officers were kind of advised to go ahead and take a very harsh position, or very, very stringent position in their interpretation of the Boyle case. And the Boyle case, just for everyone's recollection, what it involves is a Supreme Court case where the Supreme Court said, look, if you rely upon a tax professional, what you're going to wind up having, if the reliance is reasonable, the penalty itself should be removed. On the other hand, you cannot rely on a tax professional to go ahead and file a return for you. So what the IRS appeals officers has been doing is taking a double-edged sword to these kind of penalties. And if you have, say, a client who goes ahead and uses TurboTax to file a tax return, the IRS says, sorry, we can't abate the penalty because you didn't rely on a tax professional. On the other hand, when you have an individual who relies on a tax professional and you still have a penalty, the IRS still assesses the penalty because they say, look, you can't rely on a tax professional to file a return you can't delegate the duty to file a 3520. It's our job, if we're going to go ahead and take a reasonable cause position, to go ahead and really flesh out the details of the case and really advise the appeals officers that we're working with on the proper reading of Boyle and other cases that's come out afterwards. An excellent case that came out, it's in the slides, is the Verinsky case. I don't have time to go over it, but it discusses what has happened, what has resulted in IRS appeals hardline position in regards to reasonable cause, and what that winds up resulting to taxpayers who really should not have this penalty assessed because they acted with reasonable cause. All right, real quick, 6751. 6751, first of all, the same FOIA itself discussed the defense to 6751. What is a 6751? 6751 is basically IRS supervisor or manager has to sign off on a penalty before it's finalized, right? In the slides that were obtained in the FOIA, at least for purposes of the Form 5471 penalties and the Form 5472 penalties, appeals is almost kind of taking a position that there's almost a carve out where the 6751 does not apply to those information returns. I don't know if they apply the same thing with a 3520, but what's important is that if you're going to be dealing with a controversy, you should go ahead as early as possible and do a Freedom of Information Act request, serve on the Internal Revenue Service a FOIA that demands the the name of the supervisor who assessed the penalty, the process that was used, and so forth. Get that out as soon as possible. It can be very, very valuable in your case. If the IRS doesn't reply, appeal it. If the IRS still doesn't reply, consider going to district court. You can get your attorney's fees. And then finally, there's a big case that came out not too long ago, Farhi versus Commissioner, which applied to Form 5471 penalties. In that case, the situation was that the court held that the IRS did not have the authority to assess penalties. So the question is, does the same thing apply to 3520? Well, it might when you're dealing with 66039F penalties. That's the penalties assessed for foreign gifts. There's a broad reading here with the Supreme Court, and if you look at the verbiage of the statute itself, there is some verbiage missing. Basically, in order, my reading of the Supreme Court says that there's a key phrase that's missing. The provision under 6739F, you should have the term saying assessed and collected. The penalty should be assessed and collected as a tax. That is missing here, so that's something you should consider if you're going to go ahead and try to contest the penalty based on arguments similar to that of Farhi. Anyway, thank you very much for your time. I'm now going to pass it on to Steve Walker.